This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com.
Chapter 3 is relatively short. It deals with auditors' rights, their duties, appointment, resignation, and the regulatory framework within which they operate. First of all, auditors' rights, and very important rights to access all records in the audit client. This can be board minutes, it can be payroll records, it could be appraisal records of employees, contracts, any documentation, any part of the records at all, the auditors have a right to examine. Secondly, they are entitled to all information explanations that they require in their quest for sufficient, appropriate audit evidence. A director is not allowed to say, "I can't tell you that because it's confidential." The argument is that, of course, once you open the door to keeping some information back, claiming it's confidential, how do you know whether it's being kept back for proper confidential reasons, or whether it's just the director looking for an excuse to hide something? Auditors are allowed to attend general meetings, and they're allowed to speak at general meetings on relevant matters. If you remember, the general meeting is where all of the members are invited, and you have a big meeting, usually directors on a kind of a stage, the members all sitting in an auditorium, and the members often will vote at these meetings. But this is the one time where there's a absolutely direct communication possible between the auditor, who will normally be sitting up kind of often alongside the directors, but making clear that the auditor is not a director, can address directly the members. And we'll see in a couple of slides, it is the members of the company, it's shareholders who appoint the directors, and it is to those members, I beg your pardon, it is the members of the company, the shareholders, who appointed the auditors, and the auditors report to the members of the company. They can receive proposed resolutions. Interesting one before last there, they can resign before audit completion. Why would an auditor resign maybe before the start or halfway through an audit? Well, what would happen if the directors were not giving you the right information? If they were not giving you access to certain records and so on, you know that you won't be able to complete the audit properly, and there's danger there for the auditor. There's a danger there being associated with a company which is maybe trying to bury fraud, or a company which is trying to confuse the auditor. So probably better to stop and get out, even with the risk of unpaid fees, than trying to hang in there and suffer perhaps great reputational damage. And then the auditor can also have a right to information circulated to shareholders. For example, what would happen if the financial statements, when they came out and they were wrong? 2 months later, it was discovered there's some error in the financial statements, a serious error. Then it is possible for the auditors to insist that an amended set of financial statements would be sent to the members. The duties of the auditors here, the prime one is to issue an audit report giving opinions on whether the financial statements show a true and fair view, and whether the financial statements have been properly prepared. We'll see in a moment that upon resignation or being sacked, the auditors also must issue a statement of circumstances. This is basically saying why they resigned or why they were sacked, and this goes to the members of the company. And also, after they resign, the auditors are supposed to talk to the new auditors, letting the new auditors know whether there's anything that they should know about the client, maybe some major disagreement or some even suspicion of fraud. Maybe that's why the old auditors resigned. Appointment, resignation and removal and appointment. The auditors have to be reappointed at every annual general meeting. So it requires them to be put up for appointment again and for the members to vote on that. Resignation. Auditors might resign for what I will call innocent purposes. It might be that a client has simply got much larger and more complicated than the relatively small firm of auditors can deal with. Maybe the auditor's kind of getting towards retirement, wants to kind of cut down a little bit. There are plenty of innocent reasons for resignation. The big doubt, however, the big worry is that the auditors are resigning because of some major, perhaps lack of confidence or major lack of cooperation with the directors. And it's important for shareholders and others to know, why have the auditors resigned? Is there some dark secret behind this, so to speak, or is it a perfectly innocent, just the client has been outgrowing us and you needn't have to worry too much about that? That is called a statement of circumstances, the circumstances of why you resigned. Removal, again, the big problem is, of course, you're always suspicious that maybe the auditors are being removed by the directors because they're too good. So the directors can't reappoint new ones, but they would suggest that the auditors were replaced. Why is that? It could be that they think the auditors are doing a bad job, that the company's become international, but the auditors are still small and provincial. There could be a policy to change auditors every 5 years, every 10 years to get a fresh set of eyes on it. But always the suspicion we're being sacked or they're being sacked because they're too good. And again, the outgoing auditors, the sacked auditors, if you like, are entitled to and required to file a statement of circumstance at the company's office explaining the circumstances of their removal. They're also allowed to speak at the general meeting where their term of office would have expired. So you get a kind of last chance of telling it straight to the members to whom really they owe the prime duty. Regulatory environment, several different layers if you like. First of all, members of the ACCA are regulated by the ACCA. ACCA looks after your qualification, your exams. It insists that there's continuing professional development. It looks after behaviour. If you're found guilty of a crime, for example, or maybe found guilty of not carrying out an audit properly, they can fine you or ask you to leave the profession, leave the ACCA. And in many ways, this is how professional qualification like ACCA is different to an MBA. Once you have an MBA, a degree, it's yours for life, no matter how evil you become. But you're a member of the ACCA, they retain disciplinary powers over you, and you can be thrown out or fined, or they ensure that you keep up to date with current developments. In the UK, there's the FRC, that's the Financial Reporting Council, which is the UK regulators for reporting and governance. So that, if you like, is a kind of statutory body. And then internationally, there is the IFAC, the International Federation of Accountants. What they try to do, one of the important things they try to do, is to bring the preparation of financial statements and the audit of those financial statements into line internationally, so that no matter which nationalities, for whatever nationality the company is whose financial statement you're looking at, they're drawn up according to the same accounting standards, and the same standard of auditing will be done. Finally, not too important for you, a public interest oversight board. This has been set up because it was felt that perhaps the regulation of auditors is almost too inwardly looking. It's kind of auditors looking after auditors, accountants regulating accountants. But of course, very much what accountants do when they're auditing is they are doing the audit on financial statements, which are going to go to a wide range of other businesses like banking, like insurance, like stockbrokers, like investment trusts and so on. And it was thought maybe quite useful to get some input into how effective the regulatory environment and the accounting standards and auditing standards were, get a bit of input from a wider variety of users of the financial statements. IFAC's purposes, as well as what I said there, to serve the public interest, strengthen the worldwide accountancy profession, establish and promote adherence to high quality professional standards. Within IFAC, you have the IAASB, the International Auditing and Assurance Standards Board. These are the people who basically developed ISAs, auditing standards, to get kind of international quality almost. There's the IESPA, the Ethics Board. This we'll be looking at ethics in the next chapter. This sets out ethical guides under which accountants should act. We'll see words like independence, integrity, professional competence, and so on within the requirements for professional accountants. And finally, there's a TAC, not so important for you, Transnational Auditors Committee. Many companies now, of course, are international or raise money on international markets, and we just have to make sure that we take into account international considerations when designing accounting standards or audits. Who can be an auditor? Well, you have to be, in the UK, a member of a recognised qualifying body. That's the ACCA. You must be a member of basically the recognised qualifying body looks after your qualifications. And then to make sure you stay righteous, you have to be a member of the recognised supervisory body, which the ACCA is also one there. Directors may not be, auditors may not be directors or employees of the company. They have to be independent, really, from that. And they are not allowed to be an employee or business partner of a director or employee of the client.